Welcome to Financial Strategies with Andrew and Daniel Agemy, powered by the Retirement Income Store and brought to you by Agemy Financial Strategies in Guilford, Connecticut and Denver, Colorado.
Yeah, do you know in July of last year, I was able to close on like the Dream Mountain property. And we talk about what we do here as treasure hunting sometimes. And I think this story kind of illustrates where we did the due diligence, right? Spent 2 years looking for this property. And one day, this beautiful property with a lake and this and that and popped up onto the market. And because I had done the due diligence all throughout the state, I was able to see that was something without even going looking at it that was undervalued. And then as time went on and went out to the property again, realized more and more how valuable this was after it was already under contract.
Yeah.
And I remember walking through the property with the realtor saying, you make sure that this does not fall through in any way, because the guy selling it does not realize the discount he's offering. The views, the lake from the top of the property. I said, if I took pictures of this, actual good pictures of this, I could flip it tomorrow for double the price what we were under contract for. I'm Daniel Agemy.
And I'm Andrew Agemy, and you're listening to Financial Strategies with Andrew and Daniel Agemy. And we're glad to have you back if you're a regular listener. And if you just joined us for the first time, welcome. I think you're going to have a great time today as we have a great show planned for you. I'm excited about the show today. It's called Mispricings, Misperceptions, and Mistakes. And of course, we're talking about retirement and how these things apply to people in and close to retirement. So again, mispricings, misperceptions, and mistakes that happen regarding several things, both the wholesale, so to speak, as well as the retail public, so to speak. So we're excited about this. So Daniel, that's an excellent illustration of what we're talking about today. I'm so glad that you brought that up, because that property was mispriced, it not marketed properly. And, there's some people that say, that there are no deals out there, right? I mean, you have that. I want you to tell that story about the economist and the, you know what I'm talking about, right? I want you to tell that at some point today as I'm just thinking about, because that's an excellent
broker and the professor.
Yeah. And actually, go ahead, tell that right at this point.
Well, there's a stockbroker and a professor, and they're walking down the street, and the professor, the broker points down and says, look, there's a $20 bill. Why don't you pick that up? And the professor says, no, everything's priced properly. If that was a real $20 bill, someone would have already picked it up. So the broker bends down, picks it up, and they go to lunch, and they eat lunch. And the professor afterwards, they go up to pay and says, you're going to pay for lunch with that $20 bill, right? And the Wall Street guy says, what $20 bill?
That's a great example of misperceptions of people, right? And that's why we have financial strategies, because people don't know what people don't know. And because of that, they're going to have misperceptions, and they're going to make mistakes. And of course, that affects pricing on things, whether it's how much money they're paying for things, or it's how much money or what they're paying for their investments. Whether, there's all kinds of ways that people pay for their investments, but that's what we're going to be talking about today. And Daniel, I appreciate you, going through that with us today and, telling that, because both of those examples are great examples of mispricing and then misperception. From that standpoint, that people think that, it can't be that way because it would have been taken care of by now if it was. So anyway, along with this is the idea that, we can't predict what's going to be happening in the market, what's going to be happening in the world, that kind of thing. But we can prepare. And when you're prepared, you're going to be prepared for mispricings and misperceptions that happen and mistakes so that you don't make the mistakes. Daniel, what's the best way to not make a mistake?
To learn from other people, right?
Exactly.
To learn from other people's mistakes, to learn from history. I mean, that's one of the biggest things we focus on, is from learning for history. There's nothing new under the sun, right? Everything that has been will be again. And human psychology, we just keep repeating the same thing. Basically, I mean, you could look back over hundreds and thousands of years and see basically every 88 years, we kind of repeat the same things. Human emotion stays the same. Technologies are different, right? At one point in time, the technology was the train. You could get goods from the East Coast to the West Coast. The telephone, that was a big technology. And the technologies change, right? The automobile.
Right.
And people are scared of technology changes, but people pretty much respond to these things the same over and over again, just in their own time.
Exactly, Daniel. That's perfect. You know, there's always been technology, but it's been different things. Like you say, the truck was the technology, the train was technology, the car was technology. Today we have computers and various kinds of technology, but it's all technology. And that affects our world. With that, though, as you say, history tends to repeat itself. Why? Because there's one thing that is static throughout history. There's only one thing that's the same and never changes, and that's people. People are the same, and they make the same mistakes, and they do the same things. They're emotional. We're emotional creatures, and as a result of that, we are never, even the most unemotional person is not the same from time to time. That there's changes. I'm sorry. What I mean by that is going to he's not static. He's dynamic. He or she, and it's going to. There's always the human piece of emotions that comes into play with this. Well, as we're talking about this, mispricings versus misperceptions, and then comes misperceptions, then comes mistakes. I mentioned that up front that there's an aspect of how that applies to retail. And so just to explain what retail is, most of the people listening to the show, if not all the people listening to the show, it's the retail public, right? It's the people that are not professionals in it. And then the wholesale side would be for those people who are the professionals in it and are dealing with other professionals from that standpoint. But with that,
they work hand in hand too, right? Where somebody makes a mistake based on a misperception, and that causes a mispricing. Right. And we saw that a lot in throughout this pandemic, right? Especially at the beginning of it in 2020, when markets crashed, people had made mistakes in their positioning, which then led to forced selling, which led to very mispriced things. And so when your mind's prepared for these, you could take advantage of it. But this is a difficult thing for the average person to wrap their head around and to participate in, because they have jobs, they have families, they have these things that they're not treasure hunting. They're not stuck in this 24/7. And that's where that property came in, right? After spending 2 years of looking at everything that sold compared to the guy that lives in another state who's selling it, that doesn't know what things in Colorado are selling for, it presented a very mispriced parcel of land.
Yes. Yeah, exactly. Good point. So you can't predict, but you can prepare. And you were prepared for the opportunity that presented itself. And the broker in your story was also prepared, right? So if you just started listening to us, I want to let you know that you're listening to Financial Strategies with Andrew and Daniel Agemy. We're glad that you're joining us today. Today's topic is mispricings, misperceptions, and mistakes. And to go along with today's show, we put together a piece that's called Why Investing in Mutual Funds Could Jeopardize Your Plans for Retirement. A lot of people don't understand that, and that's part of the misperception that's out there, because people don't know what people don't know. So we're wanting to help you to understand, at least if you're not giving you the answers, at least helping you understand what questions to ask. So we have this paper. If you'd like this paper to be able to enhance our show today, why investing in mutual funds could jeopardize your retirement, just ask for the paper, mutual funds, when you call 800-725-7616, 800-725-7616, or hit us on our website at agemy.com, AGEMY.com, the two words AGEMY, spell our last name, and that's our website. Daniel, as we predict, you can't predict, you can prepare, right? And if you're prepared for these things, like you say, you were prepared, you had done the due diligence, you studied the properties that were selling as such, you were prepared with the finances so that you could pounce on the opportunity when it came, and that's indeed what you did. And got property that basically had a 50% discount, if not more. So there's the mispricing aspect, and the misperceptions comes in because people don't do their due diligence. And when we're talking about the retail public, Daniel, I see this so many times because people don't know what they don't know. Maybe they have been doing it themselves as far as investing themselves for years and years and years. And as much as that has been helpful to them and profitable to them, when they start getting to retirement age and ready for retirement, the misperceptions that they have because they've been doing it one way all these years can lead to some huge mistakes and them not taking advantage of mispricings that are available. And I see that in various ways. Just right here on we have this our building here in Guilford, Connecticut is on a main road here, and down this road there's various professional financial organizations, and I get to see clients from these different ones because they come in for a second opinion and such. And one of them that I'm thinking of down here is that have there's mispricing going on, in that they're charging almost twice of what they should be charging for what they're doing for clients. Well, and so there's a mispricing, but the people that are their clients don't understand that, because there's a misperception, because sometimes people have the idea that you always get what you pay for. Now, there's a certain truth to that adage, but there's also a misperception, because if you run your life only by you get what you pay for, that's not necessarily the case. Because sometimes I paid money for things that I was expecting to get good results from and good service from, and it ended up costing me more time and more money, and so I didn't get what I paid for from that standpoint. And so they're thinking that they're going to a professional, they can get the stuff, but there's mistakes. That's a mistake, because some of these and most of these financial professionals out there, when you're looking at and in and close to retirement, you need somebody that's a retirement specialist, an income specialist. But these guys are all working and working exclusively with people in and close to retirement, whereas a lot of these people are working with 20-year-olds, 30-year-olds, 40-year-olds, 50-year-olds, 60-year-olds, 70-year-olds, 80-year-olds, and they're all doing the same stuff. They're doing the same stuff the same way. And that is a mistake. That's a huge mistake. So that's an angle. Daniel, what's your take on that, regarding the retail public?
Well, the whole story with the professor is the professor believes in efficient markets, and markets are not efficient, right? That's why we call it treasure hunting. You look around and you look around and you look around. I mean, think about like these companies that are treasure hunting companies, and all of a sudden they find this big treasure. Well, how many years were they looking for that treasure? It didn't just pop up one day, right? And so you have to have that prepared mind. You have to be looking, you have to be searching, so that you're able to find these things when they do present themselves. And then also understand that it's not a fake out. Markets weren't efficient and they knew to discount this thing. There's a reason behind why it's discounted. And so the profession believed that markets are efficient, so there's no way a $20 bill could be laying on the ground. Where the Wall Street person is used to taking advantage of the situation and finding the deal. So he picked up the $20 bill. And that's what's indexing especially has caused people not to do any type of research, or they don't care what price they pay for a security, which is the opposite of efficient markets. If you just put money in something, no matter how expensive it gets, there's no efficiency. And then that means if something's not in that thing where money is always flowing to, that can be discounted tremendously until eventually everything goes back to that. Eventually, right? Nothing new under the sun. It will go back to, like, if it's happening this way and flows just keep going to this and no one's price sensitive, it can cause big problems. And like you were talking about paying too much for something, it's mispriced the wrong direction.
Yeah. Yeah. Good point. Good point. We don't want people to be able to pay too much, for that. So I see it's time for us to be able to take a break. And before we do, I want to offer those of you in our listening audience here at Financial Strategies with Andrew and Daniel Agemy, the book, The Most Important Thing by Howard Marks. This is excellent. Excellent book. We're going to be reading some excerpts from this. I think this will help you. It's not a hard read book. It is not. It is a little bit more on the industry side of things, but it brings across the concept that we're talking about. Today's topic for today is mispricings, misperceptions, and mistakes. If you'd like a copy of this book, The Most Important Thing, please call us 800-725 for your free copy. No obligation, 800-725-7616. And we'll be right back after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So Daniel, when I was a kid in the early mid 70s and such, I was very much interested in having a dirt bike and motorcycles and mini bikes and such like that before I got my driver's license. And back then in Connecticut, there was a paper called the Bargain News, and the Bargain News would come out every Thursday, and somewhere around Thursday morning, Thursday noon, or somewhere in that vicinity, it would end up in the stores. And so I was always anxious, especially in the summertime, to get down there Thursday morning, first thing, as I could, to be able to get the paper and be able to get that paper and be able to look for mini bikes, motorcycles, and things such as that, and get a good price on them. Because, I was always studying that every week. I became a student of that paper and these things and what was available out there, so that when something came up, I could jump on that and go and get that thing, get that motorcycle, get that mini bike at a good price. But I had to get there Thursday night, Thursday afternoon, Thursday night, because once Thursday night came, right, then people were getting off work and then they were showing up and taking advantage of that. But I wanted to get it during the day best I could. And so I jumped on that best I could. I'm Andrew Agemy.
And I'm Daniel Agemy. And you're listening to Financial Strategies. Today we're talking about mispricing, misconceptions, and mistakes. And Dad, that's a great story. I love how you had to be prepared, you had to be ready, you had to cash, and you had to have a plan, right? It wasn't just willy-nilly, get me there. But we're talking about things today that people may not be aware of. Mm-hmm. And you started the company because you wanted to offer people service that you didn't see was happening in the industry, but you also wanted to help people understand things that they were not being told. And hence we started this radio show, because you've been doing this a long time.
Right.
And you've seen some crazy things. You've seen a lot of mistakes.
Right. That's for sure.
You've helped some people fix them. Some people haven't wanted to fix them. Some people already ran out of money or already had problems, and there wasn't a lot to do at that point in time. And so this show is about helping people be able to ask the right questions and maybe hear things they haven't heard of before. So when we talk about examples and we talk about mistakes and we talk about these things that we've seen, it's to help people learn from other people's mistakes and learn from you're starting on your 4th decade in the business.
Right.
From the things that you've seen, the hall of shame, the wall of shame, the things that you've seen that you don't want anyone to ever go through again.
Exactly. That's exactly what this is all about. And, that's the misperception part, that so many times people have misperceptions and they don't know what they don't know. And they're not going to know because most of the places they're getting misperceptions from, they're going to continue to get the same misperceptions from, right? The talking heads on TV, the Wall Streetites, and different things like that, who are trying to just make money. And there's nothing wrong with making money. The question is, how are you making money? And if you're making money, taking advantage of people, who are seniors, people who are in and close to retirement, because they don't know what they don't know, and they're have misperceptions of it, well, shame on you. And, when we're talking about misperception, one of the biggest things in my mind that where misperceptions come from is by listening to all the media and studying all the things that there are out there. And because it's none of it is exactly congruent. And that's what we try to do on this show, is make it congruent for people to be able to understand. The first time I read the Bible, I grew up going to Sunday school and reading the Bible and doing Bible studies. But when I was 17 was the first time I read the Bible all the way through. And when I read the Bible all the way through, I was like, oh, so that's when this happened. And that's when that happened. And this is that. And it started putting things in perspective that just opened up my mind to be able to receive more and get me on a track for that which was going to be useful and helpful. But, and one of the things that is so significant, and if you're a regular listener to our show, you've heard this before, is definitions. When people are talking about words, you need to make sure that you're understanding the definitions of what they mean versus what you mean. You've heard a word like the word conservative is a word that is thrown around, but it's just a word. If you ask a airline pilot, who's gone through some bumps, ups and downs, in a commercial airline, hasn't even spilt his coffee. When you're in the back hanging on for dear life and you say, well, that was kind of that was a risky ride, wasn't it? And he said, what are you talking about? It's not risky, because in his mind, he's thinking about his fighter pilot friends or his stunt pilot friends, right? Now that's risky in his mind. Flying a plane, going through all these crazy things, that's not risky, right? So the words that you use, you need to make sure that you understand them so you don't have misperceptions when people are talking to you. I think that's the number one reason why seniors are taken advantage of, because people use words and they know they're misleading words, but it's a buyer beware world, generally speaking. That's why it's so important to have a true fiduciary helping you. But because people will use words and then people, many times because of their pride, they think, well, I know what that word is. I don't have to ask, what he or she means by that. But then in actuality, you get off track because, it's not what you meant. Well, if you just joined us, we're listening to Financial Strategies, Andrew and Daniel Agemy. If you can't tell, we're a little bit passionate about this stuff. And today's topic is mispricing, misperceptions, and mistakes. And today we have a paper that we put together that we'd like to put in your hand to help you be able to understand. And many times people have misperceptions about mutual funds. And you pay a fee for mutual funds, but there can be it can hurt you, some of the fees that are associated with that. So why investing in mutual funds could jeopardize your plans for retirement. And I'd like to send you that paper. Just call us at 800-725-7616. You can have it for free, 800-725-7616. Just ask for the paper by name, mutual funds. All right. Daniel, help me out here. What's why is this going through a big rant on misperceptions and things and definitions? Fill in the blanks.
Well, we like to keep optionality, right? And when you have optionality, it allows you to be able to participate in misperceptions mispriced securities, in mispriced assets. So a misconception is that you put your money in a target date fund, you put your money in the S&P, you put your money in the NASDAQ, and you're going to make tremendous amounts of money over time.
Mm-hmm.
So a misconception is that the S&P has done fantastic numbers over the last 20 years, right?
Mm-hmm.
Why do I say that's a misconception? Well, let's take a poll. All right. What do you think that S&P has done annualized? Okay, over 20 years, ending December 31st, 2021. So it's come down a bunch since then, but we're going from the end of year.
Well, I know, Daniel.
Well, because we already went over this, but you guessed high, right? Because you've seen people's portfolios compound over that time, and so it's tricky. It's a misconception. It's done 7.6%.
Right.
That's puny. That's
terrible.
not. I mean, inflation just came in at 7.5%. Right, the last inflation print.
Right.
And you've had 40% or more, 35% or more pullbacks in that time that you had to stomach. And one of them was 60%.
Right.
What about tech? Tech's had to do good. What do you think the iShares technology ETF has done? It's got to be 20% a year, right? Nope. 7.2%.
Right.
And so this is this misconception. Now, we always talk about if you're in retirement or serious about retirement, you need to invest differently than a 20 or 30-year-old.
Right.
Why is that? Well, if you were dollar cost averaging and you didn't get panicked in any of those big drawdowns, then you did fine.
Right.
That 7% turned into a much larger number because as the markets crashed, you were buying more shares for the same price. Shoes go on sale, right? 50% off. Nobody freaks out that those shoes that they've been looking at are 50% off.
Right.
They buy them. Maybe they buy 2 pairs. Maybe they buy it and then give some money to a charity that they care about, or they save it, or they do whatever, right? They're happy. But why are people so terrified when their assets go down?
And there's the 50% discount on buying investments.
Right. Because they're not prepared to take advantage of it. So if you're in retirement and the NASDAQ's down 15% from its high, you got $1 million portfolio. It's not $1 million portfolio, right? You're down $150,000. What do? Do you wait it out and say, well, markets always go up? Well, there's been periods of time where it's been 10, 13, 15 years where they've been flat. So if you're not buying in, that's our whole point about it changes when you're in retirement. If you're not buying in at those low spots, the numbers are not tremendous. And then if you have to take your RMD, you have to take your required minimum distribution, and your account's down $150,000.
Yep.
What are you going to do? Are you not going to take it? Are you going to have cash on the sideline to take it? That means those numbers, you didn't make 7% anymore. Right. If you had that cash.
That's right.
Right. So we can dive into this more, but this is how things work differently when you're in retirement compared to when you're in the accumulation of the saving phase of life.
Exactly. And when you're talking, when we're talking today about mispricings, misperceptions, and mistakes, and a great misperception is that things work the same way in retirement as before retirement. But that is a total erroneous misperception. People, the only people that think that way are the people who are not in retirement. And because we've been in retirement, we help people retire every day. We see it happening and recognize that things are different once you hit retirement. And when people have misperceptions like this, that it's the same in retirement as before retirement, well, then mistakes happen. And the mispricings happen, meaning that, well, maybe you sell low instead of selling high, because you're supposed to buy low and sell high. And so whether that is how you manage money or how you manage your money because of being ready for retirement. And, Daniel, I hope that we will get into some of that wholesale side after we come back from our break. But I see it's time that we take a break. And before we go to break, I'd like to offer you this book called The Most Important Thing by Howard Marks. And it's a great book, easy read book that you'll be able to ascertain things that will be able to help you keep from having misperceptions. It will be able to define things in a way that you'll be able to understand for your profit rather than for Wall Street's profit. And you can have that book for free, no obligation, by calling 800-725-7616. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is mispricings, misperceptions, and mistakes. Call us at 800-725-7616 for the book now.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
Inefficiencies, mispricings, misperceptions, mistakes that other people make provide potential opportunities for superior performance. Exploiting them is, in fact, the only road to consistent outperformance. To distinguish yourself from the others, you need to be able on the right side of those mistakes. I'm Andrew Agemy.
I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about mispricing, misconceptions, and mistakes. And that's a good quote. There's a lot to digest there.
Mm-hmm.
We talked about that a little bit earlier, where people get into trouble, where they're not prepared properly, and they're forced to get out of a position. And that's really one of the most amazing times to get into a position. I love when we see people that are forced to get out of something, and it's a good position, but they just have to get out of it, right? They got a liquidity problem, they need money, they have whatever, and so it's fire sales. They're getting out of this stuff. And when you're prepared and you have done the research already, you're able to get into those, and that's where superior results come from. And there's when we're measuring performance, there's two ways to do it. Like, we could put somebody, Joe down the street, Joe XYZ Advisors, could put you in the most risky things. And if they did that over the last 5 years, other than the last few months, because I think it's like 50% of the stocks in the NASDAQ are down more than 50%.
Ouch.
But there's a couple that are just holding the whole index up, so it's only down like 15% or so. But Joe down the street, Joe Advisors, puts you into the most risky things possible. In the last 5 years, you've done really good, and you're happy.
Mm-hmm.
Everything went well. You're talking about you can't predict, but you can prepare.
Mm-hmm.
Compared to someone that's risk managed your portfolio, where when there are black swans, when there are things that no one foresaw, like the pandemic,
right,
you didn't get slaughtered.
Mm-hmm.
You're not getting slaughtered right now as markets are falling apart. And
right.
You consistently compound those returns, even when markets are being slaughtered, even when there's periods of time where markets don't do anything. And that's what you're talking about those superior results.
Mm-hmm.
The number doesn't matter as much as the risk adjusted return. How much risk did you take in order to get that? Because we could leverage you up 8 times on the NASDAQ, and you get wiped out if the NASDAQ, like you lose everything if the NASDAQ goes down 10%, right? Compared to you have a sustainable portfolio that's going to support you, and you'll be positioned to take advantage of these things, these mispriced securities, these mispriced market conditions based on other people's fear or having to liquidate.
Yeah, and that's what we're always talking about, how, hope is not a retirement plan. And people want their retirement to be based upon guarantees and promises. But unfortunately, so many times greed fits in with optimism and they go after hope. And like what you just said, a 7%, 7.5% average return, in the stock market over the past 20 years is ridiculous for the amount of risk that was involved with it. We always have to look at the risk versus reward. Well, is what's happened so many times with people when greed and optimism pushes in, is that they forget all the bad things. They forget the pain that was associated with 2008 and 2009. They forget about fluctuations in the market. Greed and optimism tends to overcome risk aversion, prudence, common sense, caution, logic, memory of painful past lessons, all kinds of things. And so people don't think clearly. And so then they have a misperception because of their own emotions and such. And that's, as we talked about earlier, how it is that history repeats itself, because we are emotional creatures and we're always changing, we're always fluctuating. And if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is mispricings, misperceptions, and mistakes. I started this segment with a quote from Howard Marks's book that we're giving away today, The Most Important Thing. But so I want to give credit to where credit is due on that point. But these things that we're talking about today, we have a paper that's designed for you and our listening audience that will be able to help you understand how to be prepared and not have to predict. And this is called the Income Generation Report. A consistent, guaranteed, promised income that you can have throughout your life to be able to make sure that you don't run out of money, you don't run out of income. You can have this report for free. It's called the Income Generation Report, and by calling 800-725-7616, 800-725-7616. Daniel, how does this stuff come into play, these inefficiencies, the mispricings, the misperceptions, the mistakes, when you're managing money for our clients? How does that work? What happens?
Well, it's a process where the process starts with education, and it depends on what our clients, what our investors are comfortable with after going through an educational process of how all these different types of investments work. It's getting them in the right situation for what their goals are, for how much income they need, and for what they not only can handle as far as the volatility goes, but what emotionally they can handle for how the volatility goes. And so it starts there, but once they get that all figured out, it's looking at these different securities. And another misconception is diversification. People do not understand diversification properly. And hopefully on this show we could get into diversification. But so it's looking at the diversification in the portfolio so that we're able to take advantage of these things when they are mispriced. So for example, in 2016, there was a bond that came across their desk, and it was a 6% bond in an A-rated company.
Nice.
And it didn't make sense. Why is this A-rated company at 6%? Is there a problem?
That's a high rate. That's a high rate for an A-rated company at the time. Yeah.
Yeah. I mean, we just talked about over 20 years the stock market doing 7%, 7.5%, and you had to go through all a bond. They buy it back from you at a period of time.
It's got
so it was a 4-year
bond.
bond. right? 4-year bond. So what ended up happening is, after we did the due diligence, we saw the reason was it didn't have a rating from one of the big 3 credit ratings. We know that there's been all kinds of scandals with the big 3.
Right.
I was telling you about Allied Capital, this company that went bankrupt, and the short seller in the story was talking to one of the big 3, and they didn't care. They just said, we looked at the data that they gave us and everything looks fine. But it's rated by another accredited investor, and that's where the aid came from. And so people who are not prepared for those superior results don't understand that these are other rating agencies. Instead of getting paid by the people buying the ratings, they get paid from people like us, investors that want a second opinion, right? A second
Huge
opinion
difference.
on
That's right.
the finances of these companies. And so we were able to buy those, and they didn't move. It was more like a CD than a bond. If a bond is $100 a bond, maybe there was a little fluctuation. Maybe like in March of 2000, when we had the coronavirus crash, maybe it went down to 97 cents on the dollar, but you're still collecting your coupon, right? And so we held that for 4 years. It got bought back from our clients in 2001. So I guess it was a 5-year bond in 2001. I'm sorry, in 2021. And there was good deals then, because we were still recovering from all the craziness of Corona. So people got the bond, much lower volatility, essentially no credit risk, and collected the coupon, and then it came due, and they had more cash in order to take care of mispriced. There was a lot of mispriced stuff throughout that whole virus thing, because people didn't understand what was good, what was bad. Is there risk in real estate? Is there risk in these other things? And so you were able to get a lot higher quality companies that were paying good yield and paying good interest, because people didn't understand the fundamentals behind it. They hadn't been prepared in advance for that. But that's kind of a little bit behind the scenes on what goes on with picking these securities.
So we're talking, when you're speaking, Daniel, and telling us about this, you're talking about for a generalized a generalized category, the fixed income market, as opposed to the stock market. Still a market, but different, and it acts differently. And with that example of that bond that you told us about, for instance, what they did, what happened with that was for our clients that did that, it ended up being worth more. So we sold it while it was high when it came due, at which point that's when Corona had hit and so forth. So now we had money that now we were able to buy low. And that's the whole thing about investing and business in general, is buy low, sell high. So it allowed us to do that for people at a much lower risk, maybe 25% of the risk or so, give or take, if not less, than the stock market. Am I right with that?
Right. Like a 0.25, beta, meaning if the market moved 10% down, it would only move, a quarter, although that didn't really ever move because it was a very special deal. But the point was that the clients who were there and who had already made their decision to switch from the aggressive accumulation stage of life to the pay me, right? Let me buy good, solid companies that are paying me. I don't have to worry about this crazy stuff happening. They were able to participate in it. But if you came later, or there might be other deals, but that was never available again. We tried to get more of that, but there was not any more, because we weren't going to sell it. Nobody else was going to sell it either.
So they missed out. The people came later missed out on that deal. maybe there's other deals or whatnot, but every day there's new deals coming available. So if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy, and we're going to have to take a break here. But before we go, I want to let you know that today's topic is mispricings, misperceptions, and mistakes. And to be able to back up what we're talking about today, we'd like to give you this free book, Howard Marks, The Most Important Thing. Can give you a lot of perspective on what we're talking about here. So you don't have those misperceptions rather, that misconceptions come from a misperception. And so with that, you'll be able to have this, be able to encourage you, help you, and whatnot, to be able to move forward and have your retirement put in a better shape for the future and be able to live. So this book is free by calling 800-725-7616. Ask for the book, and we'll be glad to send that off to you. We'll be right back after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
Dad, you're talking about the bargain news earlier, and I love that story because it wraps up so many different things. And it makes me think about how it used to be you rushed out to go get that bargain news so you could beat people to buy those deals, to buy those mispriced things.
Right.
And the internet came along and put the bargain news out of business. It put a lot of things out of business, and it gave people more equal opportunity to find it. They could set alerts on their phone so they know this is this price, this is that. Go contact this person. They could do it while they're at work, right? They could do all these different things. They don't have to go pick up the paper and have a paper in front of their face at work like I'm reading the bargain news. And so it kind of got rid of some of those misefficiencies.
Right.
Well, one of my brothers, who's very good at finding these misefficiencies in other things, now has found his own way to find misefficiencies even on the internet that people don't know about, where he was able to buy a toolbox, right? A $4,000 or $5,000 toolbox, professional toolbox, right? For $1,400 or $1,500. And he had this whole system he put together to find these mispriced things. So even though the internet came and got rid of efficiencies, it
created other ones.
Yeah. I'm Daniel Agemy.
And I'm Andrew Agemy, and you're listening to Financial Strategies with Andrew and Daniel Agemy. Why? Because people don't know what people don't know. We want to help you be able to understand some things. Mispricings, misperceptions, and mistakes is the title of today's show. And we hope if you just picked up that, we're glad to have you with us. But if you've been listening to this today, we hope your things are going well. We're having a good time doing this. Daniel, you were finishing up talking about mutual funds, the S&P 500, which is, my understanding is it's more kind of like the S&P 10 now, because it's like 10 stocks that are driving the S&P and are doing far superior than 400 of the others or so, right?
Yeah, it's unfortunate. The indexing was started out with a really good purpose, and just like the internet put the bargain news out of business and it got rid of efficient, mispriced things for a bit of time, it created different ones. And indexing kind of has done that to a lot of individual security analysts, right? It's just made it so you put your money into the index, and over time, it does whatever the market does. It does whatever those things do. And the same with target date funds. It was a good idea behind it, but the idea behind target date funds on an academic side was to help people, and on a professional side, it was to let BlackRock earn 2% for managing your money when they don't really do anything.
Right.
It creates inefficiencies, but it doesn't help the person owning it to benefit
Yeah.
from inefficiency. So you're talking about, if we looked at the S&P in 2010, right?
Yeah. Right.
The top 10 stocks, some of them are the same as what they are now, but
Mhm.
Exxon, for example, was the biggest placeholder.
Oh, wow.
Today it's Apple, right?
Right.
But that's one, how things change, right?
Right.
Nobody wants to
Right.
own Exxon now, but in 2010 that was the biggest
Right.
placeholder.
Yeah.
But back then, the top 10 stocks was the same dollar value as the bottom 255.
Wow. The bottom half. Wow.
So that's not huge diversification, but you got some diversification going,
Right.
right? So like 2.1 trillion in the top 10, 2.1 trillion in the bottom 255.
Right.
Today, the top 10 actually represents 13.6 trillion dollars.
Wow.
The top 10 stocks, 10 stocks.
13.6 trillion. Okay.
Yeah. Okay. 10
Top 10
stocks.
stocks. Wow.
And that's the same value as the bottom 408.
Oof.
So there's not really diversification, right? Basically 10 equals the other, right? 10 stocks is the same as the rest of the index, essentially.
Right.
That used to be that used to be a way that you could get a broad variety of stocks, a broad variety of the US. And now you're buying 10 stocks. And then people, you've been talking about the investor, right?
Yeah.
The investor, the retiree, and you've been talking about the back end, the
Right.
fund manager, the investment advisor, the investments. And how that represents there is the investor thinks of diversification typically as a couple of things. Well, I'm going to buy this target date fund and get diversification because it will put me in stocks and bonds. But then when stuff like what's happening right now is stocks and bonds are selling off together, it didn't do anything like that, right? The long dated bonds and stocks are both selling off. So your target date fund is selling off. Or then you buy the S&P to get 500 stocks, but half of it almost, right? 30% of it is 10 stocks.
Right.
And so then they say, well, I'll diversify through different advisors. I have 3 different advisors, and that will be diversified. But those 3 advisors buy the same funds that own the same 10 stocks because those 10 stocks are almost in every fund.
Yep.
And none of this allows someone to get superior performance based off of that quote you were talking about.
Exactly. So what's happening with what you're just saying is the misperception that buy an index fund, buy a target fund, and you're in good shape leads to mistakes because mispricings come in because it's just dollars chasing dollars and the thing is going up, but there's no real value to it from that standpoint. And when the bottom falls out, the whole thing's going to fall apart. And bear markets come because of bull markets. They're created, from bull markets. That's why we have bulls and bears. We have ups and markets, we have down markets, and they come about. But if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is mispricings, misperceptions, and mistakes. And we have a paper that we'd like to give you to go along with today. It's called the Income Generation Report. In order to be able to make progress with your investments, make sure that you don't run out of money. Income, even if you don't need the income, the dividends and interest can be reinvesting and growing your money the old-fashioned way. This report will tell you about that. You can have that for free by calling 800-725-7616. Daniel, we don't have that much more time left on the show for this week. And, as we begin to wrap it up, my take on it is that, as far as people in and close to retirement goes, that they need to be able to know what they don't know, be able to clarify if they have a misperception or they don't, learn from the mistakes of others, and take advantage of mispricing for their benefit rather than the benefit of the companies they're working with or Wall Street. Do you agree with that, or what is your take?
Yeah, I think, some people enjoy misery. And if some people, as long as everybody's losing money, they're happy. If they're losing money, but everybody is, it's fine. It doesn't matter because they enjoy complaining about that. So if you're one of those people, you're probably not listening to the show. But if you are, then that's fine. Keep wearing the same clothes you were wearing when you were 18 years old. Keep going to the same hotels that you went to when you were 18 years old. Don't graduate, right? Don't change because as you've become more mature, you've had different interests in different things. That's the same with investing. So if you want to keep investing the same as when you were 18, that's totally fine. But for those people who want to learn from other people's mistakes and you want to try to correct the misconceptions and take advantage of mispricing instead of negatively benefit from mispricing.
Right. Well, yeah.
Then listen to these things and see what you can do. We want to help people. It comes to mind a story that I just heard the other day where this family came over from Poland because they wanted opportunity. It took them 20 years to get here. They tried for 20 years and they finally got here and they started making a better life for themselves. And they started building up some assets. The father just worked so that his kids could have a better life than he did. And there was 2 rooms in the house. So they gave them to the son and the daughter. And the mother and father slept on the couch. And they were starting to do well. And then the great financial crisis happened. And nobody had helped them understand what was going on in that situation. And they lost everything. And they still, to this day, have not recovered from that. And they're actually thinking about moving back to Poland.
Ouch.
And so that's what this show is about, is we see risks that other people are not paying attention to. And that doesn't mean that you have to give up returns. It just means you have to change the way you think.
Right.
Learn from other people's mistakes. And like you said earlier, examine what your misconceptions may be.
Right. Good. That's good. That's good stuff, Daniel. That story is just, oh man, makes me feel so badly for them that they didn't learn from the mistakes of others. They had misperceptions and weren't able to take advantage of mispricings and actually hurt them in the other direction. And that's the big question, right? When people are in retirement and things like that happen, the great financial crisis or other situations, like you said earlier in our show, even right now, the market is down 10% and you need to take your required minimum distribution. Well, what are you going to do? You're going to take it out of a lower asset value, or what are you going to do? And if this continues for a period of time, because it certainly could continue, the air goes into the balloon a lot slower than it comes out of the balloon, right? So when things go down, it goes down a lot faster than it blows up. So we have to be ready. We can't predict, so we must prepare. And when you're prepared, you're going to be prepared for mispricing to be able to use to your advantage. You're going to be able to clear up misperceptions, and you're going to be able to learn from other people's mistakes. And we hope that you and our listening audience, well, we trust that you and our listening audience have been able to learn today and be able to learn some things that you don't know, because people don't know what they don't know. And the egregious thing is when they don't want to know what they don't know. So we're glad that you've joined us today. And we want to leave you with this gift, The Most Important Thing by Howard Marks. And you can have this by calling 800-725-7616. No obligation. Just call us now, 800-725-7616. Ask for the book, and we'll be able to get that out to you. Until next week, you too can have a stress-free retirement.